As of the close of trading on Friday, August 7, 2026, the stock market is officially closed for the weekend, and Keel Infrastructure Corp., trading under the ticker symbol KEAL on the NASDAQ, finished the session at $3.82 per share. That represents a daily decline of nearly 3%, floating within a tight 24-hour trading band between a high of $3.96 and a low of $3.71. Most retail traders watching their mobile feeds see a low-priced, volatile ticker fluctuating in the high $3 range and assume they are looking at just another struggling Bitcoin miner getting kicked around by crypto volatility. But if you look beneath the surface of that $3.82 tape, the reality on the ground is completely different from what the market narrative suggests. The surface expectation across major retail trading apps like Robinhood, SoFi, and Interactive Brokers is that Keel Infrastructure is still essentially Bitfarms under a new name, carrying all the operational baggage, heavy cash burn, and margin compression of a legacy crypto hash rate operator. Wall Street pricing, however, is beginning to reflect a very different strategic calculus. While casual investors view the recent ticker change from BITF to Keel as cosmetic window dressing, institutional desks are tracking a multi-gigawatt power grab in North American energy markets. The company has assembled over 2 gigawatts of grid interconnected power capacity across key jurisdictions in Pennsylvania, Washington State, and Quebec. In a digital economy starved for energized high-performance computing sites, those power assets represent prime real estate for artificial intelligence workloads. Look at the daily market mechanics driving this equity right now. Over the past month, the stock has traded down roughly 14%, weighed down by general softness in digital assets and broader risk-off sentiment in speculative growth names. Yet institutional accumulation patterns tell a far more nuanced story. Major brokerage houses and asset managers, including Susquehanna, Morgan Stanley, and specialized digital asset funds, maintain active positions. Trading volume remains elevated as the stock approaches its second quarter earnings presentation scheduled for August 10, 2026. Retail traders managing their self-investing setups via a Robinhood stock trading account or utilizing the Fidelity trading platform are reacting to headline losses, while institutional trading desks are positioning for long-term contract announcements with major tech tenants. The immediate pressure on the share price stems from raw operational numbers reported in recent quarters. In the first quarter of 2026, revenue came in at $36.99 million, which was down 22% year over year, while operating costs escalated significantly. That produced a net loss of $145.35 million, driven by non-cash mark-to-market adjustments on digital asset holdings, debt settlement fees, and heavy capital expenditures related to site conversions. On paper, those numbers look brutal, and if you only look at standard trailing metrics on popular investing sites or inside a basic brokerage app, you might think the business is on shaky ground. But context is everything here. Management deliberately initiated a total corporate overhaul. They completed a formal re-domiciliation from Canada to the United States, established executive headquarters in New York City, and officially rebranded from Bitfarms to Keel Infrastructure Corp. On April 1, 2026. This move was designed specifically to align the corporate structure with U.S. institutional capital and index requirements, expanding their eligibility for broad market exchange-traded funds and individual brokerage portfolios. To fund this pivot without causing immediate equity dilution, the company executed an upsized $400 million convertible notes offering. That financing pushed total liquid reserves up over $530 million, including more than $330 million in unencumbered cash and a solid strategic reserve of Bitcoin. This capital buffer gives Keel Infrastructure a distinct advantage while building out heavy power infrastructure. Power grid interconnects are currently the ultimate bottleneck in modern technology deployment. It can take 4 to 7 years for a brand new data center developer to secure high-voltage grid connections from utility providers. Keel already holds established interconnections across prime locations like Moses Lake in Washington State, Sharon and Panther Creek in Pennsylvania, and Sherbrooke in Canada. By retrofitting existing mining facilities and expanding adjacent acreage into Tier 3 and Tier 4 data center campuses, they are transforming volatile, low-margin crypto mining capacity into high-margin, long-term leased infrastructure for artificial intelligence model training and inference workloads. The market expectation is that converting a power site from Bitcoin mining to artificial intelligence hosting is quick and easy. The reality is far more complex and capital-intensive. Bitcoin mining requires basic air-cooled structures with high power density but minimal redundancy. High-performance computing for artificial intelligence, on the other hand, demands liquid cooling, dual power redundancy, ultra-fast fiber optics, and strict service-level agreements. That structural shift creates an operational lag where revenue from legacy operations declines before major artificial intelligence tenant contracts begin generating steady recurring cash flow. That temporary gap is precisely why the stock trades near $3.82 today, despite sitting on top of multi-billion-dollar infrastructure assets. Wall Street's sell-side analysts have started taking notice of this mismatch. Investment research firms like BTIG and Citizens recently initiated coverage on the equity with bullish outlooks, setting price targets as high as $8 per share. Their thesis relies heavily on the replacement value of Keel's power portfolio. When you evaluate the company on a dollar per megawatt basis compared to pure-play data center real estate investment trusts or established hyperscale hosts, Keel trades at a steep discount. For retail investors utilizing platforms like SoFi Invest, Interactive Brokers Investments, or Robinhood Investments to manage self-investing accounts, understanding this valuation gap is critical to evaluating the long-term potential. To really grasp where Keel Infrastructure is heading, it helps to review how the core business model was constructed. Founded back in 2017, the organization built its reputation as an efficient, low-cost Bitcoin producer. They focused heavily on vertically integrated energy sourcing, acquiring hydro-powered sites in Quebec and coal reclamation power plants in Pennsylvania, such as Scrubgrass and Panther Creek. They even maintained a residential and commercial electrician services division in Quebec to optimize their electrical engineering capabilities internally. While that legacy model delivered solid cash flows during crypto bull cycles, it exposed the business to extreme revenue swings tied directly to token prices and network halving events. The current strategic direction shifts the emphasis away from variable daily minting rewards towards stable, predictable infrastructure revenues. Instead of taking full commodity price risk on digital assets, Keel is positioning itself as a landlord and power provider to major technology clients, hyperscalers, and enterprise clients requiring massive computational capacity. By securing long-term master service agreements, the company aims to convert its raw megawatt capacity into predictable contract cash flows, dramatically lowering its cost of capital and boosting its long-term credit rating. At this stage in the analysis, I want to pause and get your perspective. Comment below how many shares of Keel Infrastructure Corp you currently hold in your portfolio, or tell me if you think their pivot from Bitcoin mining to artificial intelligence data centers will pay off over the next 12 months. Looking ahead, several distinct catalysts and risks will determine whether Keel can close the gap between market expectations and operational reality. The most immediate catalyst is the upcoming second quarter financial release on August 10, 2026. Investors will be scrutinizing management's updates regarding site conversion timelines at Panther Creek and Sharon, capital expenditure guidance, and any formal announcements of hyperscaler tenancy agreements or co-location letters of intent. A single major lease announcement with an enterprise cloud provider could fundamentally re-rate the stock, moving it closer to traditional data center multiples. Another major factor is how efficiently the company deploys its $530 million liquidity reserve. If Keel can execute its infrastructure build-out on schedule without issuing additional dilution-heavy equity offerings, market confidence should improve significantly. On the risk side, execution delays in transformer procurement, grid expansion permits, or construction supply chain bottlenecks could extend the unprofitable transition phase and drag down valuation. Furthermore, because the business still retains a treasury reserve of Bitcoin, sharp downside swings in digital asset markets will continue to create short-term volatility in reported net income figures. When you track market trends across individual brokerage platforms, online investing portals, or comprehensive wealth management systems, it becomes clear that investor sentiment around Keel Infrastructure is split down the middle. Short-term traders see a choppy, low-priced stock burdened by past quarterly losses. Strategic long-term investors see a massive North American power portfolio sitting right at the intersection of energy scarcity and artificial intelligence demand. The current price of $3.82 reflects a market stuck looking in the rearview mirror at legacy mining struggles, while missing the structural transformation taking place on the